You're about to listen to the Yet Another Value podcast. Today's episode is my friend Chad Garcia is on for, I think it's the fifth time. He told me it's the fifth time, so he's got a shirt coming his way. But Chad is awesome. Some of his pitches, look, it's no surprise. He comes on, he pitches a stock, and then 6 months later, you see 15 generalists who've gone long the stock on the thesis that Chad pitches. He does great detailed work. He's done great work on this. We're going to talk about WaterBridge. Ticker there is WBI. It's a recent IPO. Look, see the full disclaimer at the end of this podcast, but nothing investing advice. But Chad's done great work. We have a really interesting conversation about a really interesting company because there really aren't a lot of public company parallels. And I think you'll see that's why maybe there's opportunity here. So we're going to get there in a second. But first, a word from our sponsors. This podcast is sponsored by TryTrada.com. Look, I've been harping on it for months. If you like this podcast, you are going to like TryTrada.com. It is interviews between two buy-siders who are talking about stocks they know. So it's very similar to this podcast, except, in this podcast, one person, the guest, knows the stock they're talking about, and I have no clue. And in the TryTrada.com interviews, two people know what they're talking about. So twice as much fun. Look, I've been harping them for months, and I will tell you, lots of you have gone, checked it out, listened to it, and the feedback has been fantastic. So it's not just me saying it, it's fellow Yet Another Value podcast listeners saying it. So go to TryTrada.com now and go check it out and see why I'm so excited about it and why I think you will be too. All right. Hello and welcome to the Yet Another Value podcast. With me today, I'm happy to have Chad. I can't remember if it's the third or fourth time, but one of the most popular guests on the podcast, Chad Garcia. Chad, how's it going?
Good. I think it's the fifth time. So
no way. That means you qualify for the shirt. I should have worn the shirt today. We'll talk about that after the podcast.
Well, I have my hat in the background, so
But both of our hair is on point today, though, so we can't mess that up with the hat. Super excited to talk today. This is actually one of the most interesting companies I've stumbled on this year. But before we get to it, just disclaimer, remind everyone, nothing on this podcast is investing advice. You can see the full disclaimer at the end of the podcast. So, Chad, the company we're going to talk about today is WaterBridge. The ticker is WBI. You have done fantastic work on this. So I read your Q3 letter. You and I had dinner like the night before this IPO'd, and we were talking a bunch about it. So I'm just going to toss it over to you and let you cook. What is WBI and why are they so interesting?
Yeah, WaterBridge is the leading processor, cleaner, and disposal company of produced water. They primarily operate in the Delaware Basin, in the Permian Basin. And so when oil is fracked, some water comes up. Some of that's the water that's used in the fracking process, but most of that is water that was seawater that was buried millions of years ago with the organic matter that turned into the oil and gas that they're extracting in the fracking process. And that produced water, they call it, flows out with the oil as long as the oil well flows. And so in the Delaware Basin, you get 4 barrels of produced water for 1 barrel of oil. So they call that the water cut. And then what they've noticed is that as a well ages, that water cut goes up over time. And then in various areas, some areas just have higher water cuts. So right now you're starting off with a 4-to-1 water cut. In 2030, you'll likely have a 6-to-1 water cut. And so water is the choke point for oil production. If you're Exxon and you're developing it in the Permian Basin, if you don't have a place to put the water, your production shuts down. And so WaterBridge, which went public a couple months ago, has a vast network of pipelines, but they also have a relationship with LandBridge, a sister company that went public about a year and a half ago, that owns a lot of the land where the pore space is located. And so the pore space is the geographic formation where the water is deposited. And think of that as like a landfill.
Perfect. That's a great overview. So just specifically, so you mentioned WaterBridge is handling the water cut from all of these, from this oil and gas, from the Permian, from any well that's getting drilled out there. And then You mentioned LandBridge is kind of where you take the water and you actually inject the water and kind of store it. But I just wanted to, so what specifically does WaterBridge own in this process that they're kind of handling the water?
They own the pipelines that transport it, and then the cleaning facilities that separate the oil, because there's going to be oil that's mixed in with the sludge and the solids and the produced water, and so you separate out the oil and you recover it. You can sell that. It's called skim oil. The solids get removed and deposited into an industrial landfill. So they own some industrial landfills as well. And then the remaining liquids get deposited into the pore space.
Perfect. So let's start here. You mentioned they IPO'd late September, I want to say. So, like 45 days ago. They
Right.
get picked up by, I think, 12 brokers pick them up with coverage. I'm kind of looking, it looks like 7 of them have buys and 4 of them have neutral, something like that. And, the stock IPOs at 20 and it's at $24 per share right now. So I lay all that out to ask you, like, when I look at this, I say, hey, looks like it's relatively well covered. Looks like the IPO was pretty successful, 20% in 45 days. It's not CoreWeave going up 5x in 30 days, but that's a pretty nice IPO, particularly for like kind of a more state industry. So just want to ask, is a company well covered, well regarded, successful IPO. What are you seeing that the market's missing that you think makes this kind of an alpha opportunity here?
Well, it was 11 times oversubscribed. So for an oil company, I think that was pretty good. It wasn't 20 times oversubscribed like maybe a Circle Internet Group or something. Last I counted, there was 11 sell side analysts that covered it. I've read 8 of the reports. Not one report mentions the parallels of this business to waste. And you and I, we had a podcast last year on Secure. It was called Secure Energy Services at the time. They've subsequently changed their name to Secure Waste Infrastructure Corp. That's where I learned a lot about this business. Working with them, and then also some of my investments in the waste space with connections and GFL. But similar situation between the two companies. Whereas Secure was covered for many years by energy services firms. If you look at the economics of their businesses, and if you look at some of the moats surrounding the operations, they look like waste companies. I mean, they have landfills, they have some industrial landfills. That parallel doesn't get any more cleaner. And then the pore space where you deposit it also has some very similar geographic and regulatory moats the landfill has. Secure made that connection. In the last year, they have converted most of the analysts that cover them to waste analysts or general industrial analysts. And so they've been beating on, we're not an energy company, we're a waste company for, a couple of years now. But it's in Canada, it's a small cap, nobody's paying any attention. LandBridge or WaterBridge goes public. They can't go public with something that's, a story that people aren't ready for. So they hire JP Morgan's energy bankers. They do a good job getting it public. The pitch kind of looks like a midstream pitch, whereas, a midstream pipeline business might trade 9, 10, 11 times. Maybe this one has a little bit better economics to it, a little higher return. Maybe it should go for a little bit of a premium, but, nobody's yet making the waste parallels. And, just like Secure, has been making that argument. WaterBridge's management, they report in a couple of weeks. They understand the parallels of their business to the waste industry. They are going to be beating this drum too, and they're likely going to have a much bigger megaphone than the Secure guys did, because they're an American company and they'll get a little bit more exposure. But right now, all the analysts that cover it are midstream analysts, and they're looking at it with that view and not looking at it with the waste view.
So if I was kind of summarizing what you're saying, hey, look, this IPO'd, and these guys knew it, right? They wanted to go public. This IPO'd, and people were taking, as you said, an MLP energy infrastructure viewpoint. And you think over time, and that got a defined multiple, right? You can talk to multiple as trading, but like a low double-digit multiple right now, I think is kind of what. And what you're saying is, hey, this has, one of the reasons this is an alpha opportunity is this has a lot more in common with the waste management industry. And the waste management industry probably trades for a mid-teens EBITDA. So you think there is a lot of kind of multiple expansion as the company delivers, people get to understand the story, all that sort of stuff. Am I kind of summarizing that correctly?
Well, I think they're going to have ample growth just within their business. And so from my risk management perspective, I'm like, okay, on earnings growth by itself, this is, call it a double in 5 years. I can underwrite that. But it's traded 9 times EBITDA. Waste companies trade at 15 times EBITDA, you get the earnings growth plus the multiple expansion, and that's where things get really interesting.
Well, let's talk about the earnings growth. So why don't we lay out kind of, look, they just IPO'd in September. This podcast is a little bit different to prep for because there is the S1 and then there's nothing else public from these guys yet, right? They haven't done they're in the post-IPO blackout period. We don't have an earnings call. We don't have Q3 earnings. So
well, the post-IPO blackout period ended, but it ended right into the earnings blackout call.
Yes. Blackout's a blackout. Just like, I'm not going to say my college days, but maybe every now and then, my Mardi Gras days. What are you kind of forecasting? Let's lay out, what does the valuation look like on a 2025 or a next 12 months number, whatever you want. Let's lay out that valuation, and then we can use it to build to like kind of out years.
Well, over 70% of the revenue is contracted. And a lot of the recent contracts they've been getting, they've announced like 3 large projects that they're spending capital on. And the 3 large projects are minimum volume contracts. And what's interesting is that the pricing of these contracts are well above kind of the spot rate. So the spot rate, called 65 cents a barrel for processing. The last contract that they signed was just over $1. And so that was a 15-year contract. And so that does give you some indication that the E&P companies are worried about having an outlet for their water in the future. And if they can lock it up for a decade, maybe a decade and a half, then they'll pay a premium for that. But on the minimum volume contracts alone, their volume should increase, call it low double digits. So say like 10%. But they can also pick up more business just within their existing network that's not fully utilized. Nobody sets minimum volume contracts at the level that they think they're going to do at the max level. They kind of set it below. So there's probably incremental volumes from those contracts that are going to flow in. And then, they have, 3 large contracts already disclosed that they're spending capital on. One of them is probably ripe for phase 2 expansion. I would imagine that would be announced within the coming months. And so there's a lot of growth coming their way. So it's easy to get to a mid-teens to high teens volume growth, and then again you get pricing that's going to be flowing through, and with probably not much incremental cost to it. And so from an earnings growth perspective, it should be even nicer.
But if we could just quantify, so just kind of next 12 months, what do you kind of think the near-term EBITDA looks like?
Yeah, so 25, 450 EBITDA, I think would be very conservative, and then you just compound that at 15 to 20% for the next 3 years.
Yep. So about 450 in EBITDA, and you could be talking about, if I took it a little further, 900 million in EBITDA isn't out of the question before 2030, if I'm kind of doing that math in my head.
Oh, yeah. Okay. And then from an incremental pore space perspective, they've got, they'll probably do 2.8 million barrels a day in 25, and they've got incremental pore space of 6 million barrels a day that they have access to, which is probably worth, depending upon pricing, between $1 billion and $1.4 billion of incremental EBITDA. And so, that's, you can see how they can get to $1.5 billion, $2 billion of EBITDA, just with the pore space that they currently have. And that's not including some pore space that LandBridge just bought. If you look at LandBridge's press release, they bought some more pore space. They paid a little over $200 million for it. They haven't quantified how much incremental pore space it is yet, so hopefully we'll get that on the earnings call. But I think that there is going to be a need for the pore space in the Permian, because the water cuts go up over time. The areas where they're going to be drilling in the near future are going to have higher initial water cuts. They have plenty of incremental pore space and pipeline to get it there, and so I think it's just a matter of speed, rather, as opposed to like how much growth they end up with. So it's a matter of how quickly it happens.
I want to come back to that in a second, but just to quantify it. So the stock, as you and I are talking about, $24 per share. Mm-hmm. You can correct me if I'm wrong, but I've got the enterprise value around $4 billion at these prices.
Yeah.
Okay, and we just said 450 in EBITDA. So people
probably 4.3.
So people can do that math. That slightly under 10 times, around 9 times EBITDA on the near-term numbers Chad is talking about, and then if you go out, you quickly get to 5x EBITDA if and when all this growth gets delivered. Let's talk about that growth. So, these guys, the returns on invested capital here are, I don't want to say insane, but they're really effing good, right? You're talking about multi-$100 million projects, these pipelines, all the space and everything, and they're getting 20% plus returns on invested capital unlevered, right? 25, 30 is not out of the question.
Yeah, the $1 billion of incremental pore space, incremental EBITDA from pore space that they have would probably cost them $3 to $3.5 billion to realize. And that's if it's like a platform. And so you have Speedway project right now, which they're probably getting like a 3-year payback on that, on an EBITDA level, right? That is running right through a sour gas region that's going to be developed shortly. There's already minimum volume contracts on processing of that sour gas. Like that's right for an expansion of the Speedway pipeline. I would imagine when you're expanding a pipeline as opposed to initially putting one in, it's probably a 2-year payback.
But that's what I want to ask, because these returns are phenomenal. Like these are phenomenal for infrastructure assets, right? So I want to.
But they're not paying for the pore space as you would do like this.
We'll talk about the pore space when we talk about LandBridge in a second. But just the returns of their infrastructure projects are phenomenal. And I'll bring up this a couple times, but I've done a little bit of work on midstream pipelines, especially offshore oil and gas pipelines. And offshore, those are pristine assets. And when these guys build, and there's lots of, you're building things 3,000 miles under the sea. The returns there are like 20 to 25%. So these guys are actually getting better returns. Now, as you said, there's no pore space, but I just went, why can they get these types of returns? Because in my mind, billions of capital, 30% returns, people try to compete that away, right? And we can talk all the ways people can, but just high level, why do they kind of have the rights to get such great returns on pretty significant amounts of capital?
Well, I think it's the relationship with LandBridge. So look at where a lot of this water is flowing. A lot of this water is flowing out of New Mexico and into Texas. And if you're going from the north-south part border, I mean the western part of that is TPL property, which LandBridge went and kind of a lot of the acres there are checkerboarded, and so TPL had a big area with checkerboard. LandBridge went and bought up the rest of the checkerboard and entered into an agreement with them, and so they've got that area locked up. There's a ranch just east of that was one of the initial areas where they would put in shallow saltwater disposal wells that's kind of overpressurized, and so there's not going to be any incremental pore space there. And then there's a ranch next to that where there's no wells on it currently, and then you're back to LandBridge property, and then it starts to go up into the Panhandle. And so anytime you want to cross land, a landowner is going to want to take a toll charge on the water that's kind of crossing over their land. And so it's not only having a massive pipeline network, but it's having one that's kind of efficient where you can avoid having to cross property where you have to pay.
Let me so let's go to LandBridge right now, right? Because I think that's the first thing when I read this S1, when you and I first started talking about it, it's the first thing that jumps out to you. They have a sister company, LandBridge. Right. And for those who don't know, and I know this because we've talked, I've read your letters. Chad was very early on the LandBridge story, and the stock is up even after a recent pullback. 150% since it IPO'd?
I did 17 and it's at 60 maybe today.
Yeah, so the reason I first started, my ears perked up when you mentioned WaterBridge is I was like, oh, Chad pitched LandBridge. This guy knows. But I think there is a question. LandBridge is WaterBridge's sister company, right? They are sister companies. You can hear it in the bridge. They have the same controlling shareholder, all this sort of stuff.
No. They have the same sponsor, but the shareholders are different, and
my fault. This is the same sponsor who does own a ton of both of these, right? But I think the question, my first question when you see this is, you said, "Hey, why can they charge this rates?" And it's because they cross the land. And the corner store at the corner of a really great, 86th and Lex, it gets a ton of foot traffic. Doesn't mean that it's going to make a lot of economic profit, because guess what? The landlord keeps charging them every time the landlord's taking pricing, and they're going to keep charging kind of for the marginal customer. Here, I guess my first pushback would be, hey, yes, I know they've got a sister company in LandBridge, but why isn't LandBridge ultimately the one who's saying, hey, the pore space and the land is the critical thing. We're going to keep charging you, and we get all the economic profit, not you, the pipeline.
I think it's having both the pipelines and a pipeline network that provides redundancy. So if you're an even-year operator and you have one water company and they have one pipeline to one amount of pore space, like that might work for a few years. But what happens if there's something that goes wrong with the saltwater disposal well? It loses its permit. In years 5, 6, 7, 8, 9, 10, they could have a force majeure. So you want to have a vast network with multiple access points for saltwater disposal wells. And so it's having the whole network, plus the pore space that gives it its real value. And so, both of these entities are creating value. And, LandBridge gets paid a nice royalty fee. Some would say maybe a little bit above market, but I think it's within market now. But over time, as pore space is used up, the rates that WaterBridge charges and the rates that LandBridge charge should both go up in tandem. But there is a risk that WaterBridge could privilege LandBridge, and some economics kind of squeak out there. But keep in mind that Devon Energy owns 20% of WaterBridge and is a big customer. I doubt Devon would like to see some of their economics as a shareholder of WaterBridge squeak out to LandBridge, and they're a big customer, and so there's a stick there, right?
I'm going to come to Devon in a second. We'll get there in a second. I did look it up. Devon is mentioned 135 times in the S1, so I really do want to talk about that. But I want to ask one other question, right? So LandBridge has the land. They are the landlord who owns the property at the corner. You kind of can't get around that land, right? You've got the land. That's a great spot. The other way returns here could get competed away is, yes, WaterBridge builds the pipeline, but somebody else could come build the pipeline, right? A lot of these are new builds or expansions. And somebody else could come and say, or even, Devon, ExxonMobil, these customers, they've got huge balance sheets. ExxonMobil owns and knows how to operate pipelines. They could say, hey, WaterBridge is about to spend $3 billion for $1 billion in EBITDA. Why don't we just do that ourselves? Or why don't we go to name your other water operator here and say, hey, why don't you guys spend $3 billion for $900 million in EBITDA, right? Like take that return rate down and start having people compete against each other. So my second question is, why?
So Devon did enter into basically a call option on pore space type agreement with LandBridge, and so they, the history of this is the operator goes to the water company goes and finds the landowner. That's the history of the industry. But Devon, who owns part of WaterBridge, is worried about access to pore space in the future, and they went and forward contracted pore space with LandBridge directly. So they went around WaterBridge, but in doing so, they did commit to use WaterBridge as the deliverer of it. But to your point, these companies can have balance sheets and have ran water businesses in the past, but the trend is for the large operators to divest of their water businesses, because you want some scale, right? So you want to be able to handle the water of operators that surround your property, right? But if if Exxon has a water asset and you're some small independent company and they say, hey, you can use our water asset, if pore space becomes tight, who do you think is going to get squeezed out? right? The small operator. And so it just makes much more sense for these water companies to be independent. I mean, if you look at Diamondback, had a water business called Rattler that they spun out, and it traded at a horrible multiple because they couldn't maximize the value because of that dilemma. And they ended up selling it to Five Point, which is the sponsor behind WaterBridge and LandBridge, and that asset's is in the Midland Basin now. I do think that asset, would work well in WaterBridge, and ultimately, you may see it merge with WaterBridge. But to my point, if WaterBridge is getting mistreated and LandBridge is getting privileged, I mean, how happy do you think Diamondback, who owns a good chunk of Deep Blue, that asset, would be and wait in line to kind of merge these assets together? I think that there's plenty of people within the WaterBridge shareholder base that are also customers with big sticks, just to make sure that everybody's treated fairly.
Let me ask this question in different. The Devon deal, we mentioned that multiple times, and now I think we can all understand why they would go with LandBridge, right? Again, LandBridge has the land; you need to go with them. Right. But you said they went behind WaterBridge's back, did LandBridge, and then decided to do it all through WaterBridge. Devon had, I believe, they had an internal operation that they could have done this. They could have tried to find a third party. Why does Devon choose to go with WaterBridge here?
Why? Because they have the space. I mean, why do they choose not to contract with WaterBridge? Or
why does Devon choose to use WaterBridge for the pipelines, right? Because Devon I think Devon had internal operations. They could have tried to do it themselves. They had the deal with LandBridge. They could have tried to they chose WaterBridge. So why do they choose WaterBridge? And they take equity.
Right. Well, probably because they own 20% of it and have a vested interest in seeing it do well.
But they got the 20% from choosing WaterBridge, right? So they did still have to choose.
I think it was probably committed assets at one point in the history.
Okay, that's good. Let's go to something else. Just elephant in the room. We mentioned the LandBridge deal a little bit, right? You mentioned how, hey, there's a lot of customers who own WaterBridge stock. So if LandBridge is getting favored, they're going to have a big problem, and you don't want your. But I think people are going to read the S1 and they're going to quickly jump and say, hey, there's the LandBridge relationship. I've got worries there. 5 Point is the sponsor here. There's the tax receivable agreement. The 5 Point has other assets in the industry. Just like there's a lot of potential for conflicts of interest here. So that is kind of the elephant in the room when you look at this business. How do you think about all of that?
Well, it's 5 Point is the controlling sponsor, but the funds were different funds in WaterBridge and LandBridge. And so they've been managing this conflict for a long time. And the way they've done it is first by setting up policies where if it's a low-level conflict, here are the policies. And then if it's a higher-level conflict, they set up independent conflict committees made up by the shareholders of each of the funds to get together and work them out. And so they've been managing this for a long time, and they've done it well. And I think they'll continue to do it in the future. Plus, you have Devon in WaterBridge, and maybe Diamondback at some point if they ever merge Deep Blue into WaterBridge. So
weird risk here. When you read the S1, and you mentioned it earlier as well, a lot of the business is taking water from New Mexico, where it is difficult to permit water assets, taking it from New Mexico and bringing it across state lines into Texas, where it's easy to get permits, right? That's a ton of the business. You can read the S1 and there's all these arrows going from like the middle of New Mexico right into Texas.
Right.
Is there a regulatory risk here in one of two ways? Either, hey, New Mexico gets a lot easier on permitting. So a lot of this infrastructure that's designed to take water out of New Mexico into Texas is kind of excess capacity. Or the other way, Texas says, oh my gosh, we're having early in the fracking and disposing of water, people are putting water into fault lines and causing many earthquakes and stuff. Texas starts saying, oh my gosh, we need to regulate this. We're having risks of earthquakes. We're having environmental risk. Is there any risk in that regulatory, because they're almost regulatory arbitraging, if that makes sense? Is there any risk in one coming down, one coming up?
Well, Texas is, so the initial saltwater disposal wells, when the fracking industry was created, they would put it into deep water wells, which is basically old vertical wells that were kind of empty. And so they put the water in kind of deep formations, and that caused a lot of the seismic activity that fracking is known for. And so they stopped doing that. And then they put them into shallow disposal wells that are slightly above the mineral formations. And a lot of the industry would use 4 disposal wells per section, where LandBridge or WaterBridge throughout their history has used 1. And WaterBridge's philosophy is that if you under pressurize your disposal well, it can last, almost forever. They have some that are over a decade old, and you run less risk of having an environmental issue where it blows out a well and comes out on the surface, or you interfere with surrounding neighbors' E&P operations. So that's been like their practice. The rest of but it's expensive practice because it requires you to have 4 times the amount of pore space than the industry was using. Okay. Some of those issues have come up. They've blown out some disposal wells, and it's caused some environmental damage. Not WaterBridge, but the industry. Some of the wells have been overpressurized to the point where they've interfered with oil and gas production of surrounding neighbors, and there's some lawsuits going on there. The state of Texas got involved in 24 and changed the regulations. So not only do they permit the volume of water that can go into a disposal well, but they also permit the pressure of it. And WaterBridge claims that they've helped write those regulations. And so basically they've increased the regulations to bring the rest of the industry up where WaterBridge was already at. Okay, so I don't think you're going to see any more regulation from the Texas side because they've already made a very big change.
By the way, I totally believe WaterBridge when they say that, because one of the things that jumped out to me via S1 is WaterBridge notes that they are responsible for roughly 40% of the water injection permits in Texas and New Mexico. And that just blew my mind. Like that's so much of it by one company. So I totally believe they have a big hand in any regulation that's happening there.
And they do it better if you see them in person, which I hope they have an analyst day. We can get to that. But there is a slide where they have the pore space, and it's like in red where it's like over the overpressurized areas
with the four red. Yeah, I know exactly what you're talking about.
When if you see in the IPO process, they were able to do that like a time lapse one. It was pretty amazing to see. And so if they ever do an analyst day, which hopefully they do, it'd be nice to see that. But with respect to New Mexico, you have federal land, you have private land, and you have state land, and and they're all kind of intermixed. And so you've got like 3 levels of regulations there to deal with. And so it may be difficult, even if they wanted to make a change, to actually get stuff done. And even if they did make a change, I don't know if the operators would trust it because, changes have been made in the past, and then 2 years later, you have a new administration and they revert back to it. And these guys, the E&P operators, they wanted to, they have an oil well. It's going to go for a decade and a half. They want the problem to be gone. So, even if people start making noise about softening regulations in New Mexico, A, it's probably very hard to do, and B, I don't know if anybody would trust it.
Perfect. One thing that when I started looking at this company, you will hear energy bulls a lot. We'll talk about how the Permian is getting gassier. The tier 1 stuff has been kind of tapped out. And basically calling for Permian oil output to decline. Even if money invested goes up there, they're saying, hey, Permian's going to decline. And look, all of this is Texas and New Mexico water assets for the most part, right? So I just want to ask you, if the energy bulls are right, if the Permian is not the growth engine for the world's oil anymore, how does that kind of play into WaterBridge's hands, or not play into it, I guess?
Well, the Permian's large. It's not just the Delaware Basin. And so I think that within the Delaware Basin, there's going to be oil output for a long time. And it's the lowest cost part of the Permian. And so, you can definitely see how other basins in the U.S., if the U.S. is going to decline in its oil production volume, It's definitely going to happen in other places. It can happen in parts of the Permian, but the Delaware is going to be the last place for it to decline.
Well, you can also correct me, but I think one of the reasons it's declining is because the easiest stuff has gotten tapped. So the newer stuff is gassier. It is heavier water cuts. So even if you're seeing the overall volume of oil going down, there's the chance for these guys that they're going to actually see water production go up. Now, you can correct me if I'm wrong.
You will see water production go up. I mean, it's right now the water production of a well goes up as the well ages. So you have that. But I was reading today that they expect the water cuts initially to be at a 6 by 2030, whereas right now it's at a 4. So
that's 4 barrels of water for every 1 barrel of oil, and going up to 6 barrels of water for every 1 barrel of oil.
Correct. I mean, some areas in the Delaware Basin are 10x.
If speaking of energy bulls and bears, this is all of this water is coming off because oil is getting produced for the most part, right? Where oil has gone from, if we were doing this podcast 2-ish years ago, oil's in the 80 per range. If we're doing it 3 years ago, oil's in the 90 per range. Today it's in the 60s. The forward curve are in backwardation. It's in the mid 50s if you go out a year. Where do oil prices need to go where, hey, you start seeing some shut-ins or wells decline, and you start saying, hey, even if the cuts are getting waterier, the volumes just aren't there. Now, we do have the MVCs, but there's just not going to be any growth. So it's starting to impact WaterBridge. Oil's at 100, doesn't matter. Oil's at 90, doesn't matter. Actually, great for them, right. But there's got to be some price where you start seeing volumes really decline. Where does that really kick in?
Well, I think that ongoing production, I don't think you'll see shut-ins unless you have like a COVID situation where demand stops. Like the ongoing production will keep going. It's the new drilling that slows down, and you're already seeing a lot of new drilling slow down. So, that's happening, but the produced water volume is still holding up. So if you look at, again, we don't have WaterBridge's first report, but if you look at Secure, for example, their rig count was down 15% last quarter, and their produced water volumes were down 3%. And there was a lot of facility shutdowns that may have affected that. So it could have just as easily been flat. So
earlier we talked about, hey, near-term EBITDA, let's call it 450 million. 3 to 5 year out EBITDA, let's call it 900 million. The path to basically doubling EBITDA over the next couple of years, how much of that is organic in terms of pricing and volumes versus organic in terms of building out, that $1 billion plus in capex we talked about at 30% unlevered versus inorganic?
They got 10-year contracts with minimum volume commitments, at probably growing volumes at 10%, and then pricing layers in. So I think you're pretty well covered. And then the gassy region the sour gas region that hasn't been developed yet. I heard that there's capital being committed to that, and get oil prices in the 40s, it's still going to go because people have already started signing up for minimum volume commitments and processing the sour gas, and that would be another project that WaterBridge will do to service the water needs of that area, which should be coming, should be announced pretty shortly, and I can see that generating cash flow by 28.
If we're talking 28, it's probably more a 29 or 30 thing, but let's say 900 million in EBITDA, right?
Right.
Can you break down what's the? There are pipelines, there are real physical assets here. What is kind of the maintenance capex required for that 900 million?
Yeah, I kind of look at Secure as a comp because we don't have as much data on this one. And Secure, keep in mind that 30% of their business is pipelines, and so they do have some pipelines in their business too, like that which is like oil takeaway pipelines, not pipelines as much affiliated with their water business. Although some of their newer growth contracts do have some pipelines, and then they have to pay for pore space, and their maintenance capex has increment, replacement of pore space within it. And they're about, maybe 15% of their EBITDA goes to sustaining capex.
Cool.
So I think that would be a pretty good comp here as well.
Yeah. So, I mean, on the 900 million EBITDA, and obviously there's interest and other things, but this is a
140 maybe. So 140 of maintenance capex on that.
This is a very, I think people hear, oh, assets, they think there's a lot of maintenance capex. This is a very cash flow rich business, as you would expect from a pipeline. Like that all the pipeline businesses, you put it in the ground and they last 30 years, and there's, just.
I mean, you look at Secure, and they're doing the same type of ROICs. I mean, like they have the pipeline, the gathering and transportation pipeline in the business. But if you look at what they're talking about when they deploy capital, they're deploying it at in the waste business, they're deploying capital at kind of 25% unlevered IRRs initially, with the ability to put more volume through that as those businesses grow. And so, they can work those up in the upper 20s and low 30s IRRs.
Let's use 900 million in EBITDA, 140 million in, let's make the math really easy and just say 750 million in unlevered free cash flow 4 to 5 years out. Obviously, there's a lot of growth projects here in the next couple of years that's going to consume a lot of EBITDA. But at some point, the great thing about a high EBITDA business that's growing a lot with not a lot of capex is you're generating just a ton of cash flow. What does capital allocation look like kind of as the growth projects, as the cash flow kind of starts to exceed even what they can put into growth projects?
Well, I think it depends upon the valuation at the time. And I think obviously they would do some nominal dividend in order to check the box for investors that have to have a dividend paying stock in order to invest in it. I would hope that they don't go too crazy. Like my favorite dividend is like the de minimis but growing one, to check those two boxes. And if you need to pay a big one because your stock's overvalued, you can do a special one. But these guys are, they're very commercial savvy, and they're very financial savvy. So I think, if their stock's undervalued, they're going to be preferring share repurchases.
And if on that 900 million in EBITDA that we kind of said, hey, this goes right, all these growth projects, they get a couple of years out. How do you think about multiple and valuation at that point, just so people kind of know what they're playing for 4 years, 5 years out?
I mean, I think that you look at one of the waste companies that reported in the last couple of weeks, and they have a oil recycling business that they're putting money into pretty significant. It's like 400 or 500 million, and they're talking about a 7-year payback. That business trades at a much higher multiple than what WaterBridge trades at, and WaterBridge has 3-year paybacks. So I think people are going to be making the connection, and where the waste multiples are out there in the mid-teens. I mean, don't take my word for it, or don't take Secure's word for it, who's been beating that drum for a long time. Take Waste Connections' word for it. Waste Connections is one of the highest quality municipal waste operators in the country, and they invested in R360, over a decade ago. I think they paid like 7.5 times EBITDA for it, when their multiple was at like maybe 7.8 times. So it wasn't, both their multiples were low. And then in 24, they bought 20% of the industry's capacity in Western Canada by buying the Secure assets that the competition tribunal forced Secure to sell. And rumor is they bought a small E&P asset in the Permian that was sold by a sponsor in Q1. And so the waste companies definitely see that the attributes of these businesses are similar to theirs, if not better than theirs, and they're putting money into this business as well.
So if I'm just doing that in my head, so you're saying, hey, look, 5 years out, 900 million in EBITDA. Let's assume that all the free cash flow between now and then goes to growth capex, though I think that's kind of an aggressive assumption. So 900 million EBITDA, 15x multiple if it's kind of the waste multiple. So you're getting to 13.5 billion of EV. They've got, what is it right now, like 2 billion of debt. So you'd get 11.5 market cap. And you get 11.5 market cap. I think they're around 3 is the market cap post IPO. So you're kind of looking at a 3 to 4 bagger on that math. Am I kind of doing that right in my head?
Yeah. Yeah.
Okay. Okay. Let me ask just 2 pushbacks on the multiple, right? And I don't think it super matters because you could do the same math that I just did on a 10x and you would still get a pretty solid return over the next 2 years, but over the next few years. But let me just do some pushback on the multiple. I mean, I do hear you on the 15x, right? Like these are quality businesses. But I guess the 2 things I'd point to is Waste Connections. You mentioned they bought some stuff, but when I think waste, I guess it's permanency of the assets is what I think. Like people are going to come AGR or whatever, 100 years from now, people are going to be, their trash needs to be taken out. I don't know if the Permian is going to be getting drilled in the same way, call it 30 years from now. So, I mean, maybe, but is the difference between this at 10x and the 15x that Waste Connection should get, is it kind of the questionability of the terminal value of the assets? Does that make sense?
I think that, well, the wells are going to produce for a long time, so over a decade. So even if you're drilling 10 years from now, those wells will still be going. But yeah, say it deserves a slight discount because you have a little bit more terminal value risk there, or maybe there's the perception that the revenue is a little less resilient because it's tied to oil and gas.
Yeah, I don't think it's matter. I don't think it crazy matters, but
yeah, let me finish. But
yeah,
okay, so say you it deserves a little bit of a discount, but then I would say, well, what premium would you give it that it doesn't have to pay for the trucks? I mean, look at the ROIC of a municipal waste company. I mean, they're horrible. I mean, 10%, 11%, they're growing, but they always have to replace the trucks. Like you don't have the collection assets that the municipal waste has. And so, yeah, I mean, are there some attributes of the municipal waste companies that I'd like to see in this business? Yes, maybe you should knock it a little bit. Yes, but on the other hand, you got to, with respect to the maintenance capex that you don't have here, I mean, that's a big premium.
Great point. Let me ask you, if I put oil prices aside, because we mentioned oil prices, the Permian's going to be producing at 50, Permian's going to be producing. If you said oil prices are going to 10, this probably isn't the investment for you. But if I put just dramatic collapse in oil prices to the side, what keeps you up at night about WaterBridge? Or alternatively, we talked about a lot of this growth is built in. It's MVCs, it's contract pricing, all this sort of stuff. Again, what breaks this? What keeps you up at night? What could stop that inevitable march to the 900 we talked about, where, if we're recording this on your 10th podcast appearance 3 years from now, we say, hey, this didn't work out for XYZ reason?
Yeah, I think that, some environmental disaster or something like that, a pipeline breaks, you have some expensive lawsuit, some remediation work that's real expensive. I mean, that would be worrisome. I think that I don't think it's a long-term risk, but anytime you have something that's complicated with respect to like this, where you have the sister company LandBridge and WaterBridge, it's always going to be ripe for short reports to attack it. And so, you may wake up one day and it'd be down 20% because some short report came out. I don't think that is like a long-term issue for the business, but it doesn't make it fun in the short term.
This is completely off the cuff, so forgive me for this, but on the remediation and pipeline spill, I mean, I've been involved with pipeline spills before and on the oil side, and it's a disaster, right? It's generally pipeline spills in the ocean, but even on the ground, it's a disaster. Oil kills everything, it coats everything, kills everything. If you had a pipeline spill here, I mean, I understand this water is not potable, right? You and I aren't going to go drink this water or something. But if you had a pipeline...
Yeah, it's corrosive. It's nasty stuff.
But would it be as big a disaster as oil, or because it's, I mean, at its base, it's water, would it be like, hey, eventually it evaporates and it kind of goes away and it's not as bad? Like, an oil spill, we're talking hundreds of millions of cleanup. Here, if there's a spill, is it tens of millions? Is it single digit millions?
Yeah, I don't know. Probably drive a lot of business to their landfill.
I,
So if it was a customer that caused the spill, then it'd be fantastic. It'd be business generative for them. But
no, that is true. I was just curious because sometimes it does help when you quantify the actual downside. I do merger arbs. Merger arb, you're always worried about the break and downside, but every now and then you'll have something where it's like, hey, in between the deal announcement and the deal close, they announced 4 new contracts for 100 million each. Guess what? The downside used to be 40, now the downside's 50, and that completely changes the calculus. If the downside here is oil spill a la Exxon Valdez, and we're talking billions of cleanup costs, that's one thing. If a spill here is, hey, we need to go, I don't know, take hair dryers and evaporate all this water.
I think the environmental damage of the Exxon, Valdez in the ocean is probably much more dramatic than it is in the middle of the desert in the most desolate part of the country, too.
That's exactly one of the many things I was driving to, right? Like it is very desolate pieces of the desert, so maybe a spill can be remediated in a lot of cheaper ways than kind of we think about spill. Yeah.
I mean, oil prices are obviously like the big risk that you want to keep an eye on. I think that it could be a good thing to have low oil prices in the short term just to prove out the resilience of the thesis, but definitely it's tied to oil. And then the LandBridge, WaterBridge, common management, dual stock kind of structure just makes them susceptible to. I mean, they have to manage the conflicts well. They've done it in the past. I think they'll do it in the future, but you'll have short reports coming out where they make some claims.
Yeah. So I've probably asked 4 questions on the potential for conflicts of interest. And I think you've had good answers and they've managed this for years, but you've said it is there. A short report will probably come out at some point highlighting the conflicts of interest on one side or the other.
Well, they already have.
Oh, really? I hadn't seen any.
There's one that came out before WaterBridge went public, but yeah.
Okay. I will go find that. But why even have these as different businesses? I understand it strikes me that just the integration would make a lot of sense here.
Well, the integration operationally makes a lot of sense, which is why they do it. But then, if you look at land royalty companies like Texas Pacific and LandBridge can trade 25 to 40 times EBITDA. Like that is not going to get appropriately valued within a WaterBridge. And so it makes sense to have that separate.
I think I hear you though. I guess at the same time, if you put these under the same roof and you did segment earnings and started breaking them out, everybody would just say, oh, how are you doing segment pricing? So they probably have the same issues and you'd never get the multiple. But it does strike me that it just seems like these businesses belong together.
Well, as a shareholder of both, I kind of like having them separate. And if it makes people more comfortable, I'm a larger shareholder of WaterBridge. So
that's great. I think we've covered everything I wanted to cover. Anything else you want to talk about, or anything a listener should kind of go away thinking about?
I think we're pretty good. I mean, the thesis is pretty simple. There's a lot of organic growth within the next few years. It wouldn't surprise me if they do an analyst day, which I really think is needed because right now most of the people that are looking at this are energy investors or midstream investors. You want to get the waste guys looking at it. You want to get the journalists looking at it. The concept of pore space is tough initially to get your arms around. I mean, it worked out for me because I was invested for years in TPL. I would see the royalties that they would get paid for their produced water business. I owned some waste companies. I sat down with the Secure guys at a conference and they explained the business to me. And so for me, it was a little easier to get because I've had so much exposure to it. But I think LandBridge and WaterBridge, like, you really need to have an investor day. And, now that they're both public, I would see it. I could see them doing that in the next, 2, 3, 4 months.
Forget the investor day. You know what they needed? They needed you to come on this podcast because I know you came on this podcast for Secure 12, 15 months ago or whatever. And then all of a sudden the trail, you mentioned the journalists. How many journalists do you see having, they write their letters and they say, hey, new position, Secure. It used to be Secure Energy. Now it's Secure Water Solutions.
Yeah. Secure's got a nice cadre of fans on Substack and Twitter. Canadian companies are a little bit different there, where you don't have to report you being a shareholder unless you're over like 10%. And so
Yep.
there are some pretty clever funds that I do know that are within the secure shareholder base that I wish they would disclose their positions, because it would help get a lot more exposure to that company. But you brought up LandBridge on the secure call that we did, and LandBridge got inbound calls because of that. And so that helped me get closer to the management team and probably secure a larger allocation of the WaterBridge IPO. So I have you to thank for that.
Good for you, man. That's awesome. Cool. Well, hey, Chad, this is great. I'm going to go count up the podcast because if this is the fifth one, we're losing the tie for the next one. You've got the exclusive Yet Another Value podcast shirt coming in the mail. But this is great. Looking forward to chatting soon and looking forward to the next podcast.
All right, man. Have a good day.
A quick disclaimer: nothing on this podcast should be considered investment advice. Guests or the hosts may have positions in any of the stocks mentioned during this podcast. Please do your own work and consult a financial advisor. Thanks.